Okay, let's get started. Good evening and welcome to the Inside Market Analysis. My name is Jeff Killian. I'm a private securities trader, technical analyst, and educator. And as always, before we get started, I always want to take a minute and say thanks to everyone for joining us, for taking the time to be here with us, with an open mind and with the expectation of learning something new. And that something should always be what you can immediately take and incorporate into your current methods to become a better trader or investor. Tonight I'm going to present to you a market analysis of the Dow Jones Industrial Average, and we're going to run through a fairly extensive, comprehensive view of how the market arrived at where it is today, incorporating the 5 indicators that we use here every day to analyze and trade what we trade, to be able to determine what is the current state of the market and what is, moreover, the truth about the future directional price movement of the markets. And after that, we're going to run into a single stock presentation of an actual trade that was taken by myself, a very recent, very highly profitable trade. And I'm going to show you how I found it, the indicators that I use every single day to trade, what the move was on the stock, and how we calculated the reward to risk ratio, as well as the price profit targets, and the percentage that was made on the trade. For those of you that are new to us tonight, I have been trading in the markets for the past 13 years, and I use nothing but technical analysis to make all my trading decisions. And tonight I want to talk a lot about technical analysis because that is what we do here. And technical analysis really is the foundation of profitable trading. And learning the correct application of technical analysis is really the necessary skill, and it is a skill to become a real-life profitable trader. And when I say real life, I mean a person who works in this business every single day and who is profitable month after month after month consistently. Technical analysis has universal application to futures, forex, option stocks, ETFs, fund timers, whatever you want to trade, it all begins here. And what we employ here is matching and modeling the superior methods of professional traders to truly gain the learned confidence that you need and the positional advantage that you're going to have to employ in order to succeed at trading. And that means taking the trade in the moment when it arrives. We need to develop a trading methodology that helps us find and trade with the smart money. Now, when I say smart money, I mean the people who actually move prices. I'm talking about insiders, institutional people, pension funds, people that have hundreds of millions of dollars who actually get together and decide what is going to move. And they're the ones that make it happen. So here, through time-tested techniques, the ones that worked 50, 75, 20 years ago, 5 years ago, and yes, 10 days ago, on my last winning trade, you will learn the necessary skills to take your trading to a brand new level. Now let's talk about something else that's very important to us here. I know that a lot of people want to learn how to trade. And we've had a lot of emails in the last 2 weeks. Since the summertime is coming, there's a lot of people who are actually studying and gearing up for the fall instead of going away because they need to figure out another way in order to make this happen for themselves and be able to actually learn how to trade profitably. And the way we do that is by using the time-proven indicators to analyze and trade. Objective analysis is what's happening in the world today. This means analysis that can be quantified, verified as actually being the truth. It did happen, and there it is right before us, as not the same as subjective analysis. Subjective analysis is more like an opinion about something. And therefore, it's a gray area. It cannot be quantified and verified as being the truth. So in this case, we eliminate subjective and go completely with objective analysis. We're going to talk about the MACD indicator, stochastics, money flow, the volume indicator, support and resistance level, Fibonacci. And again, remember, always objectively interpret your indicators to make profitable trading decisions. This is where the rubber meets the road. The true value of an indicator is its real ability to predict future directional price movement. What we do as technicians, and what you will learn here by studying with us, is the study of price movements within charts using mathematical indicators based on price and time. Again, volume analysis, we look at chart patterns, trend lines to determine the current state of a security, and as always, the greater probabilities of its future price directional movement. Now, technical analysis is the preferred method to use to determine if there's a real opportunity or not. Again, because it's 100% objective. If you are a fundamental trader and you are not using technical analysis, you are missing out on profitability. When you combine both, your trading takes on an entirely different level of profitability. So now let's get right into a presentation on the Dow. And I'd like you to see exactly what I'm looking at and how I do what I do. What you're looking at is an end-of-day chart of the Dow Jones Industrial Average. Can everyone see that okay? Could I get a yes, please? Again, an end-of-day chart of the Dow. Candlestick chart with the volume in the subgraph below, including an overlay of a 21-period average daily volume in the red line, again in the subgraph below. Now, volume is the catalyst behind some of the biggest and most profitable moves any market, any sector, any group, or any stock has ever seen. And this will never change because supply and demand dictate everything. And essentially, when there's more demand than supply, however that arrives, prices will move up. When there's more supply than demand, prices will even out or turn back around and retrace back downwards. Now, as you can see by this volume spike right here, let me blow this up a little bit in the subgraph. Right here, this was the catalyst for the move that brought us all the way up to this point here at about 12,400 and some change. Now, at this point, the market's corrected back down here, moved sideways, and then back down to this low where we had another substantial volume spike right here. And again, these two areas are the smart money people moving back in the markets, which propelled the prices back up to this level here. Again, very close to our previous high here. Now, at that point, prices had a short-term correction and then moved up again to this level here at about 12,780 and then turned right back around because of this volume sell-off here, and has led us all the way down on this medium-term correction to where we stand today at 12,048. Now, employing 5 simple indicators. Again, beginning with volume. We run through a sequential order of a qualification process to be able to determine what is the current state of the market. And I have to say before I leave this chart that we are not per se practitioners of candlestick patterns. We don't use any special software to be able to wait to trade markets, groups, sector stocks when certain patterns have officially developed. We use candlesticks because of the clarity and brevity that they provide us with versus any other type of charting. Candlesticks has proved out to be able to enable you to visually determine the difference in an instant. And I'm talking about these market turning points right here, 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 and here. So that's why we use them. Well, let's move right on to the next chart. Now, right after volume, I always want to take a look at the money flow index, money flow indicator. And in this case, I'm using a 21-day. Now, we can see clearly here that between this price level and this level on the money flow index, as compared to this price level and this level on the money flow index, we had an official negative divergence, clearly showing us that the money was leaving and there would be a correction. The money flow index allows us to be able to confirm volume insofar as that, what do we really have? Do we really have what we think we have? The tide of real and confirmed institutional smart money insiders in this market, in this stock, or not? And sure enough, the divergence, the negative divergence signaled the market would correct. And sure enough, it went sideways and then corrected further to this level. Now, as on the previous chart, you saw the volume spike and the money flow turn right back around. Here we have an up move. This spike on the money flow indicated that there would be an additional move in the market itself, because more often than not, money flow is early because these people come in early and ride those positions up for a forward date sell-off, which is exactly what happened here, the short-term correction, and the market moved up again here to this level. Now, at this point, here we go again. Look at this. Money flow was on a serious negative divergence at this point right here. This price level, as compared to the level on money flow, and again, this price level, as compared to the indicator level here. And sure enough, prices have once again fallen off, and our short-term correction, I believe, at this point is just about exhausted. And let's move on to the next chart. The stochastics indicator is our leading indicator, and it is always the preferred method to analyze the reversal points, to be able to determine what are the realities, the validity of future directional movement. And as you can see, stochastics here, I use a 21-day with a 3-period smoothing average cross from below 2 above here, and then again from below 2 above the 20 line, confirming this move. At this point, we had a negative divergence where stochastics was flat, plated highs here. Stochastics fell off again, and sure enough, there goes our correction. So this is our leading indicator for future directional price movement, in that it will always be at the forefront, being the scout, ahead of every other indicator that we incorporate on our end. Let's take a look at the MACD here for a second here. Now, on the MACD side, we had a crossover from above to below, and I'm using 26, 12, and 9 parameters on the MACD, standard MACD indicator that's in almost any charting package. And it signaled a down move here, and it's not just the indicator levels. It's the momentum of the actual indicator itself. How fast is it moving down? What's its momentum? What's its rate of change? What's the velocity? What's the real story behind the movement of this indicator that the price action itself is not saying yet? It's saying, if it's saying anything, that there are high probabilities that prices will again correct to the downside. And short, after this consolidation period arrived, they did. Now we cross from below to above here. Same story. We have a negative divergence where the MACD is flat right here. I'll draw it for you in real time. Right here. And I'm going to raise this up a little bit so you can see this more clearly. The MACD was in fact flat. While we have the extended highs, the inflated highs here for the final buy-in, where the retailers thought that they had an opportunity, and the institutional people took advantage of that by taking out all these stops on the way back down and made a ton of money. Just by following the handful, not even the 5 indicators that I've showed you so far, you could have been out, back in here, out here, and waiting to be back in here long. And if you wanted to be short, you could have been short here, long and short, and waiting to be long again, just by following what I have laid out so far. I want to take a look at something else here, and I always employ 4 and 8 day exponential pair of moving averages, exponential moving averages on the market side, and I use the 3 and 7 day on the stock side. And this is for good reason, because we need to be able to confirm what those indicators have told us at these critical market turning points. Do we again have what we think we have? Do we have the confirmation that these moving averages have crossed, in this case from above to below, in this case from below to above, and in this case from below to above, and in this case from above to below? I like the 4 and 8 day pair in the market side because it hugs these market turning points to give us the kind of confirmation that I look for, that I won't trade without. And I don't want you to either, until you're absolutely sure. One confirms the other, that confirms the other, that confirms the other, that confirms the other, until we are sure that we are on the right side of the market before we trade anything. Now, our chief market breadth indicator that I don't trade without is the advanced decline oscillator, or the advanced decline line. In this case, we're looking at the advanced decline oscillator. And at this point right here, we had a short-term negative divergence signaling the falling off of the buying pressure, now becoming selling pressure. Because however you want to interpret these indicators, there's only one way to tell the truth of exactly what's happening. In the advanced decline oscillator, the advanced decline line, we're looking at the total sum of the market participants in the form of the shares that are advancing divided by the declining. And here we are with this sell-off here, massive sell-off, while the market was still moving sideways. Remember, we had the same thing happen on the other indicators that we looked at, and sure enough, there's our additional correction. Sideways. The volume spike was here, price move up, again, peaked out here, and dropped off sharply, indicating that this correction was in play. What you have just witnessed is only 5, and we don't need much more, of the most time-tested, time-proven indicators that exist in the trading world today. What happens is that any trader who's been trading for a long time will tell you the same thing. They may not trade exactly the same way. They may not necessarily use the same trading methodologies, but they'll all agree on one basic tenet, that the simplest methods are the ones that work the best. And these are the ones that make the most money and limit the risk time after time after time. And I mean month after month, year after year after year. And this is why we use them. So now at this point in the market, I want to go back and I want to show you the final piece of, not the final, but something that I believe that I have done more research on than almost anyone. And this is on Fibonacci, and namely Fibonacci retracements. The laws of nature have direct application to trading markets and individual stocks, forex options, ETFs, funds, whatever you want to trade. Now, for those of you who have attended the previous webinars, you've seen actual proof of how I connected other data points and prices got magnetized to those levels. So what I'm going to do is I'm going to back up in time here just a little bit, and I'm going to show you how I connected 2 different data points using Fibonacci so that you can see how it actually lays out future price levels that the markets and stocks get magnetized to. So first thing is we have to know where to connect these data points. And in this case, I know, because I have studied the correct application of these techniques for more than 15 years. So here we connect this data point right here with this point here. Let me make that correction here. Okay, here we are. This point and this point here. Now, at this moment, we have to understand that this is what we were looking at. We had a swing high here and a pivot point high here and a swing low here. So we connected this initial data point with a secondary point here. And I'm going to shrink down the money flow index so you can see this a little more clearly. Now, this is all I need are these 2 points. As time moved forward, prices corrected, and they actually found this level right here and stuck to that for some time and then traded through it to the downside. Here, corrected up, found this level again, and then turned right back around and continued to move down to lead us to where we are today, right here, right at about the 61.8% level. Now, previously, when prices moved up, they hit here and then again here. Now, at this point, when prices steadily move down, you have to understand, now that's a figure of speech we need to understand, this is all a process that plays out in time. The corrections, whether up or down, land at these levels that were laid out in previous time based on Fibonacci levels. And right now, this is where we sit today. So this is not a coincidence. This is something that more than 90% of the time these prices stick to. And I'm going to get more into this later on an individual stock trade that I made shortly ago, a highly profitable trade. So we use Fibonacci because it works. And we need to always incorporate as many tools as we can in our toolkit to be able to stack the probabilities in our favor, because this is what we want. We want to be able to take only the highest probability trades that come across the table. And your greatest positional advantage as an investor or trader is that you don't have to trade if you don't want to. If there's no trade, don't take it. If there is something and it is a high probability trade, then you can take it. But this is not the place to use trading as a pastime, because this is a business and we have to treat it as one. And we understand that we may work every single day and there's nothing. And then next week we may work every single day and we could have 2 winning trades at 4% apiece, 5% apiece, and pick up 10% in a week. And if that happens 2 weeks out of the month, where does that leave us? It leaves us at 20% for the month. And that's a very attainable goal, trading the methodology that we teach here. So I'm going to close this workspace out and we're going to open up the single stock trade and we'll get right into that. Do we have any questions on that before we go any further? Questions? John, Roger, Mary, Mahesh? No? Okay. Then we'll proceed. Okay, what you're looking at is, again, an end-of-day chart, daily candlestick chart of a recent profitable trade taken myself. And the symbol name is forex, and this is in the pharmaceutical sector, traded off the NASDAQ exchange, symbol FURX. Now again, here we have the same situation. This came on my radar screen right here at this area, at this pivot point low, where we had this historical volume spike right here. These are the kind of things that I look for. I'm looking for prices that have slowly moved down into a nice, discernible, low volatility, new pivot point base formation, where I'm sure that I have this type of chart pattern set up with high accumulation, telling me that there is a possibility that this stock could turn right back around and move to the upside. Now, again, with this kind of volume pressure, we know that this is not normal. This is almost an historical volume spike. So this tells me right away the insiders are in this stock. The question is, when is it going to move? And this is how we start. Put it on a watch list and we go. The next chart we're going to look at is, again, money flow. Money flow was on a positive divergence, signaling that there was accumulation underway. And money flow, sure enough, after the positive divergence, as compared to the price level here and here, crossed from below to above zero. The ultimate confirmation that I'm looking for when I want to get in and trade a stock. You could have drawn a trend line here as well to have seen the break on a breakout within the wedge from below to above that trend line, and then another confirmation from below to above the zero line, signaling serious upside potential. So this is the confirmation for the volume. And next, I'm looking at the MACD. Here we have the crossover from below to above and a trend line that I drew for you, so you can see the long-term trend line was established on the indicator levels itself as compared to the price action, because if you just looked at the price action, you would never see what I have just demonstrated to you, right? No, it would be impossible. It could not be discerned. So now let's take a look at stochastics. Stochastics was almost flat, 2 points up, signaling a positive divergence to the upside, as again compared to this pivot point low here on the price action, and crossed again as the MACD did from below to above here with serious upside momentum. There's our leading scout telling us that this stock is on its way. Next, let's take a look at something that a lot of people miss out on every single time. And where did we end up with last time? Before Fibonacci, 3 and 7 day pair of exponential moving averages. And here we are again. You can see right here, and I want to blow this up for you so it becomes more clear, that at this point, let's just make it a rectangle. At this point right here, to zero in, we had a cross from below to above on trade day. And this is where we update the intraday charts, looking at an actual end of day chart on an intraday basis, again, every 15 minutes, because it reflects the actual end of day, signaling that the indicators that you have applied, the same ones that you will apply by studying here with us that I do, to have the ultimate confirmation to enter into your trade. Now, Fibonacci again. Every trader would like to be able to determine what are the realities of the price move. And so here, we always employ Fibonacci. Now at this point, I connected this data point and this data point right here, which laid out 23.6% retracement, 38.2, 50%, 61.8, and a full 100% retracement getting back to this price level. Now, remembering all the charts that I just laid out on this stock, we had everything lined up, didn't we? So now that we have everything lined up, how do we determine when we're going to get in, where we're going to get in, when we're going to get out, and how we're going to get out? And the beauty of the methodology that we teach here and being able to find the smart money, either through one-on-one developmental training or the foundations course that's coming up, I'll talk about that in just a minute, is by employing Fibonacci retracement levels. Look at this. After this pivot point low was established, I immediately connected this point and this point. And you know, let me get rid of it so I can immediately show you in real time how I did it. Here's the 2 points that existed. Remember, again, we're always talking about this is where we were. There was nothing in the future. This was the day. So let's go to Insert on the Metastocks program, Fibonacci, retracements, and we're going to connect this data point and this one right here, and we release. Now, as time moved forward, we had our big day up here, the actual day that I got in. Now, the beauty of this methodology that I teach is that I know where I'm going to get out before I get in, so I have my risk-reward ratios all calculated. I know that I can get back to 38.2. I'm looking to get back to 50% to lock in my profit before anything goes sideways. I'd like to get to 61.8, but my ultimate price profit target is 100% retracement. And more often than not, that's how the RRR is calculated, where it's calculated from. Okay, so we're going to step on the gas a little bit here. Now, at this point, I'm in this day right here, and I'm in at this level right here. I'm in at 1462, and I have a price profit target at $17 flat, this level right here to get back to. That's 100% retracement. Remember, the stop I laid out at $14.15, right below the low of this day. So I know if the stock turns right back around on a low, more than likely I'm not going to get stopped out with everything lined up the way it was. So in this case, we always want to keep our stops far enough away that we don't get stopped out by the volatility of the average true range of the past 4 or 5 days according to a chart pattern, or volatility that could exist within the 15-minute charts that we make our decisions on in real time to actually determine the levels that we can get in and out at. But the end of day analysis determines everything from the beginning. And in this case, I knew that if I placed my stop at the 415 area, there was more than a 95% chance, according to my calculations, that I was not going to get stopped out, and I did not. So again, the initial protective stop is right here at 1450. Right here is where we got in. Here's our 61.8% retracement level to see if the prices are going to bounce off of that, or we have additional volume to stay in a trade and ride that position up. Now, at this point, I'm looking to find out how long I can stay in this trade. And I'm usually looking at 3, 5, 7-day position times. So I know that at this point right here is more than likely where I'm going to get out. But this move only lasted 2 days. So I'm thinking to myself, well, let's see what happens. If we get more volume, we'll stay in for one more day. And maybe we have one of the best winning trades of the last couple of months. And we get to the 100% level. And sure enough, that's exactly what happened. We got out at just short of the 100% level here at 1680. So let's run down the numbers. We got in at 1462. The stop was $14.15. So the risk became 47 cents. Now, with the move where it landed up and that profitability, we made about $2.38 was the expected move. We rounded that down to about $2.18. So here we stand with a trade that lasted 3 days, a 3-day hold time, a $2.18 profit. So the way to calculate that is $2.18 profit divided by what we paid when we got in at 1462, left us at a 14.9% gain in the trade, a 3-day hold time. This was one of the best trades that I have made in the last 3 months. If you only made one of these a month and you had no other trades, you just brought in 15% that month. And it wouldn't matter how many shares you traded, because the percentages are always the same trading this methodology. This is how we do it. The distance from where we got in to the stop was the risk. The distance from where we get in to the price profit target is the expected return. The price profit target. If you divide this distance by where you got in from where you expected to get out, the reward to risk ratio on this trade is 5 to 1. This is why this trade moved so far, so fast. And this is the way we do it. This is not normal swing trading. This is high probability swing trading. This is where everything is lined up so that you are sure that when that moment arrives, you can put on a big position and make a lot of money in a short period of time, and when it's over, you get out and you look for the next high probability trade. This demonstration is a more in-depth demonstration on a single stock trade that I have given in the last year. And I wanted to share this with you tonight so you can see for yourself exactly how a professional analyzes and trades a real high probability trade. Nothing less. Questions? Do you have any questions about the techniques that I've just laid out? Yeah, we have a question. The advanced decline oscillator is same as Chaikin oscillator. It depends on what package you're using. In my case, I'm using Chaikin, and I like that because I use a 21 period advanced decline oscillator, or in some cases advanced decline line, but it's always 21 periods. All the indicators that I use, like stochastics, advanced decline, the average daily volume, 21 period, they're all static for a reason. I have done extensive testing, system testing on indicators in isolation, which is what a trader does before he trades when you get more advanced. And every single indicator that you've just seen that I have tested out has, in isolation, brought on the highest profitability on its own again, using the time frames that I incorporate in my trading. What search did you use to find this high volume stock? Mary. Mary, how are you tonight? Thank you for joining us. Mahesh, did that answer your question okay before we move forward? Yes. Okay. Mary, I have a volume scan that I use, and my analysis, again, is all end of day, so my scans are all end of day. The end of day analysis is the mother of all time frames to be able to analyze and trade with the highest profitability. And so I have volume scans of greater than or equal to $5 and less than or equal to $25 because we don't need to overpay for any blocks that we want to buy. And the reason is because more often than not, as you've seen how the prices have moved down before they shoot up again in every stock that I trade, these stocks have already traded. If I bought it per se hypothetically at 5, you can be sure that it already traded at 7, 10, 15, and maybe $20. But because of the cyclical rotation, maybe the fundamental reasons out of favor coming back into favor, there was nothing wrong with it. It was a perfectly solid stock. It was just out of favor coming back into favor, and we were able to find it. So on our volume scans, we're looking for a price-based parameter first, and secondly, 2, 3, 4, 5 times the average daily volume, 21 period. And we're back to Mahesh for a second here. Where to find the advanced decline oscillator? If you're using the Metastock program, which I recommend because of the tech support, because of the data checking that they assure us, you'll get it right there in that program. It has a drop-down menu at the top. and you can call support. By the way, anybody who's interested in the Metastock program, we just made a new deal today, and you can call Greg Allred at Metastock in the sales department. And our brand new deal is that we have the lowest pricing out of any other vendor, period. So I wanted to share that with you while I'm thinking about it. I'm using Metastock 11 end of day. I don't know about end of day. I'm using Metastock Professional. But that's a question to ask support. Those guys are great. They'll get back with you right away. And if not, there's a possibility you might have to upgrade. But I don't think so. So any other questions before we proceed? Okay. Very well. So that concludes the single stock presentation. Again, 3-day hold time, 14.9%. Now, they don't always come in at close to 15%. A lot of my trades come in at 4, 5, 7, 9, 12% on a recent trade before this, as you saw in the last IMA webinar. But if you add them up and you sum those numbers up at the end of the month, there isn't any reason why you can't be well above 10% every single month and live a balanced life where it doesn't own you like day trading does. So again, that concludes the single stock presentation. I want to just talk here a second about your winner trader investor checklist. And here it is. First, we need a well thought out trading plan. We need the discipline to follow that trading plan when the moment arrives. And the only way you can do that is by doing the work yourself. Because if you're following a system that you bought, it's impossible to have the same conviction to put on a big position when the system generates a buy or sell signal as you will do. When you learn these indicators, when you learn this methodology about how to find the smart money yourself by studying here, you have the conviction to put on that position when the moment comes. We need sufficient investment capital to trade. We need a solid working foundation of technical analysis, which is exactly, again, what we teach here. We need excellent money management techniques to limit that risk to a minuscule amount of money. We need the willingness and desire to overcome all obstacles and create our success environment in trading. This is something else we teach here. Okay? Because your environment is what's going to lead you in a very large way to become the successful trader, the money-making trader that you want to be today. Last but not least, I'd like to talk about what's available. And starting June 20th, running through June 21st, we have the Foundations course. And I'm very pleased to announce that we already have the entire structure set up and revamped, a 5-day Foundations course. And this is going to guarantee you exactly that, the foundational skills that you need in order to become a real-life profitable trader. And it is designed with one goal in mind. It's to take you from the beginner or novice to intermediate level in a fraction of the time. Now, I have taught many traders. And I have had traders who've been trading for 5 to 10 years. And they've walked away from this course, studying here, totally amazed at the new skills that they have been immediately being able to incorporate into their methods to become more profitable traders. It's a 5-day course, again, divided into 2 separate 1.5-hour live trader-led sessions by me. The first one begins at 4 p.m. Eastern Standard Time, and the second one begins at 7 p.m. Eastern Standard Time. Now, on this webpage, on the site that you're looking at right now, the Inside Technician site, is a large part of the outline that is in the course, including some of the real-life testimonials of people who have actually studied here and learned what we teach and turned it into actionable intelligence to be able to trade. We teach the most comprehensive course, I believe, anywhere on the web today. Just an enormous amount of information imparted to you in this intensive, comprehensive course in 1 week. Everything is presented and recorded in a webinar environment. So when it's complete, you can either access it on demand when and wherever you like at your own convenience on our servers. Or if you like, you can download it and keep it for life. It's your choice. I'd encourage you to investigate this course, take a good look at everything that's available. Questions, call me. I'm here to answer anything that's related to any of the services we offer, whether it's this or one-on-one developmental training to help you get where you need to go. This course will sell out fast. We have 1 seat filled, and we have a major promotion that's coming out tomorrow to the entire Metastock database. So this is not going to last long. I don't have any idea. I've already been asked when the next course is going to be. We'll cross that bridge when we get to it. So again, thank you for joining us tonight, and stay tuned for the next live presented IMA webinar. We don't have that posted yet, but it will be on the site shortly. Again, this course starts on the 20th and runs through the 24th. $2,600 US guaranteed. My personal guarantee to get you where you need to go in a short period of time. This is Jeff Killian for the Inside Technician. Again, thank you for joining us, and we'll see you shortly on the next Inside Market Analysis. Good night.